All right, everybody, welcome back to another video here on Financial Friends. Today, we're going to be discussing 5 tips for beginner investors. This was inspired by the bonus tip that you can see on screen that I have for you as well. So technically 6 tips here in this video. If you're new to Financial Friends, the Financial Friends YouTube channel, or any of the platforms as a whole, Financial Friends stands as a community of people who love business, finance, and investing. I'm just sort of the head content creator for the moment. Plans to expand Financial Friends are definitely there, but if you want to be around for those plans, hit subscribe, hit the like button down below. Let's go ahead and dive into today's video. 6 tips for beginner investors. So the first tip, it is the bonus tip right away. Make mistakes when investing. This is not financial advice, but I will tell you that in every other arena of life, everything, college, jobs, relationships, your personal life in any way, shape, or form, whatever it might be, we make mistakes whether we like to or not. But the problem with investing is people feel as if they can't make a single mistake. And what that does is prevents people at all from beginning investing. You might never start simply because you're afraid to make a mistake. You might hand your money over to a financial advisor who ruins your financial future by making poor money mistakes simply because you were afraid to make one yourself. So don't be afraid. Dive in head first, explore the world, and take a look at these 5 tips coming up here. Use them for inspiration. And let's go ahead and dive into the video. Remember, there are no mistakes, only lessons. Number 1, time is your best asset, not money. You could see here the 2 comparisons of the famous compound interest calculator with an initial investment of $0 here on this left side, $250 monthly contribution for 40 years at 8% interest. You will have $777,000. Now take time, split it in half. Take your money and split it in half, and you do not have the same outcome. So for anybody who assumes that if you are going to push investing down the road and then just double the investment you make at that point, it's not going to work like that. Compound interest time is your best friend. So a $500 monthly contribution for only 20 years instead of 40 and $250 at 8% yields $274,000. Not quite that initial investment. So remember, time is your best asset. Now, number 2, high risk comes with high reward. It is very important to balance those. Now, I have a couple of points here. Risk comes in all shapes and sizes. Risk could be holding one single stock. Risk could be taking a long bet on a penny stock. Risk could be using options, which are essentially leveraged positions in certain stocks. Risk comes in all shapes and sizes, but risky is associated with investing and not investing. It is inherently risky to invest your money. You are giving up your money with no guarantee of a return whatsoever and the possibility you lose every single penny of it. That is what investing is. That is inherently risky. But not investing, not growing your money with the largest companies in the world or in the United States or in a bond or in any type of investment, alternative investment, cryptocurrency, real estate, anything, not investing any form of money is risky. It means you're holding all cash and you're subject to any amount of inflation that could potentially happen in the United States, which right now is pretty high inflation. The third one is, and it goes hand in hand with the first and the top one, or the second and the top tip here, you have to take risks. You have to. You have to be okay with doing that. Going 100% stocks when you're early in your life, or you're early in your investing career, it's not necessarily as risky as it might be at 60 or at 70, but it's still risky, and you have to do that at some point. You have to give yourself up to risk at some point, whether it's through not investing or through investing. And number 4, time can heal. Not any amount of time, not in any situation. So you need to make sure you protect yourself by doing tip number 3, which is not placing all your eggs in one basket. Time can heal, but time cannot heal if you take your life savings and put it in Bitcoin and Bitcoin goes away. So you have to be okay with diversifying your assets. And I have this example here. I have a note. This is a very oversimplified example. But if you're investing in one asset, We're going to use Coca-Cola for this example. It could be only real estate, only Bitcoin, only Ethereum, only Apple, only anything. One asset. And that asset decreases in value, in this case 20%, you now have lost 20% of your money. But if you diversify your assets, and the video that is shown here is single stocks versus ETFs, that video can be found on the YouTube channel with a link up here. Make sure to finish this one before you head over to that one. But if you invest in an ETF, if you take stocks, ETFs, cryptocurrency, real estate, and you mush them all together to form a portfolio, you now spread your risk out. But for a simplified example of this particular ETF that we have made up with a circle, if Google loses 5% of its value, Amazon gains 5%, Meta loses 7%, Starbucks gains 1%, and Apple gains 10%, you now have netted out positive 4%. Now, this in and of itself is an oversimplification because of weights and other aspects and prices and yada yada, but the point being, spread your risk out so that if one asset goes down, not all of your exposure is to that asset. Number 4, taxes are a factor, so use retirement accounts at some point. You have to pay taxes. I know you might be young. You might not assume that taxes apply, that they're going to go up, that they're going to go down, they're going to go. Taxes are going to come into effect. We all know that. It's one of the 2 guarantees of life, but taxes are going to happen. So what you can do is use retirement accounts to legally not pay taxes. You can see here this chart. I know it's a little blurry because I had to blow it up so much, but when you earn money and you use a Roth IRA or a Roth 401k, you pay taxes. But you don't if you sell for a profit, receive and reinvest a dividend, or withdraw cash from the portfolio when the time for doing so comes, which is after 59.5. In traditional IRA or 401k, you don't pay taxes when you earn, sell for a profit, or receive a dividend, but you do when you take that cash out. In a brokerage account, you're getting hit all the time. You're getting hit when you earn money, you're getting hit when you sell for a profit, you're getting hit when you receive a dividend. So, all of these examples are examples of when you could avoid or get stuck with a tax bill. So use retirement accounts because they allow you to not have to pay those taxes in particular circumstances. So make sure you use them. They are important and you can learn about them here. Number 5, use websites like Investopedia.com. They are fantastic tools. We're in the world of social media. You're on YouTube. You are already using a tool for learning. I'm over on public.com. I'm on Twitter. I'm on Instagram. I'm on TikTok. Check me out on all those platforms. All those platforms are great tools. You do need to know how to sort through relevant and good information. You can do that on Investopedia.com. I'm not associated with them. I'm not sponsored by them. I'm not paid by them. I personally love and use this website each and every single day. So Investopedia, this is the main page here. And what you're going to find is news, the top lists of CD rates. They're going to, source information together for you. I'm hiding this here, but they did an update on the 2023 tax brackets. They have current stock information or index fund information. If you use the education tab, you can find how to invest, how to trade, a dictionary, economics, Roth IRAs, corporate finance topics, ETFs, 401ks. You hop down over here to the key terms or the dictionary section. You can get definitions on all of the words that may or may not be giving you some trouble with finance and investing as a whole. And their articles are always updated. You can see this was written by Brian Beers and reviewed by Samantha and fact-checked by Kirsten, and it is updated as of July 5th, 2022, so any relevant information on any particular topic can be included. So, those are my 5 tips. Those are the 5 things I think that you should be doing. Go ahead and leave a like on this video if you did learn something new. Comment what you learned if you did, and leave some video suggestions down below. Financial Friends is all about you, the viewer, you, the friend group, and the community. So let me know what type of topics you want to see me cover, and I will definitely do that. Thank you very much for watching. Do hit that like button, and I will see you all in the next one. Take care.